Many traders are trading technical analysis the wrong way. In fact, they all make a very common mistake while trading with technical analysis, which is making it too hard for a lot of traders to make profits from the market. And this mistake, if left unchecked, has the ability to keep a trader unprofitable for years. And I will be revealing this mistake as we get deeper into this video, including the high profit trading strategy that I used to make more than $120,000 from the market. And by the end of this video, you can also be able to copy these concepts and create an income generating machine for yourself using only one strategy. But before we get into all of that, do well to like this video to help other traders find it and also become profitable, and subscribe to our channel if you are new here. So my tribe soldiers, let's begin to install this strategy into our mind. But before we progress, for the sake of the beginners here, let's first understand what is technical analysis. Technical analysis is one of the two ways of trading the financial market. Okay, basically, we have two ways of trading the financial markets, which is the fundamental analysis and technical analysis. The fundamental analysis is based on trading the market, using the informations gathered on financial news reports, while technical analysis is the act of trading the market based on the real price movement of the asset. The asset could be stocks, cryptocurrencies, currency pairs, or indices, and as traders, we mostly use the Japanese candlesticks to trade them. But even with the Japanese candlesticks, you are not going to be trading blindly or buying and selling the market at any time we wish. That is why we create trading strategies, and for sure you are going to find a lot of these trading strategies on our channel. But in this video, I am going to teach you a special trading strategy that not only works 90% of the time, it provides solution to the one problem that 90% of traders face in the market on a daily basis, and this problem is called the false breakout. Some traders call it a liquidity sweep, but there's a huge difference between a false breakout and a liquidity sweep. Liquidity sweeps usually occurs at reversal points when the market is trying to change direction and move into a new trend. So it have to take out a lot of trades to gather liquidity and move the market. But the false breakout usually occurs when traders are trading against a trend. So the market will trick them to enter the wrong trade and then move against them totally. So you can see this difference. The liquidity sweeps take out trades to gather liquidity and later move the market to the target direction. But the false breakouts will take out the traders' positions and reverse against them, totally moving in the opposite direction. So there are more chances of a trader making profits on liquidity sweeps than on a false breakout. Now, follow carefully. The first way we solve the problem of the false breakout is to really study and understand the movement of the trend, to understand exactly where the market is moving to, which is not actually be hard for you to do if you have been following me on this channel. But here is it. To understand the trend, we have to know exactly how the trend actually works and how it starts. We have two dominant trends in the market, the uptrend and the downtrend. When we say the market is moving in an uptrend, what we actually mean is that the market is doing more of buying than of selling, and the buyers are in control of the market, meaning that as long as the market is maintaining that momentum, we are going to be seeing more of the prices of that asset moving up than of the prices going down, which means that to profit in this market, you will have to be looking out for only buying opportunities in order to follow the trend correctly. When the uptrend is forming, it starts by creating a higher high, a higher low, and then another higher high. Whenever you see this setup on the chart, you should be prepared to only look out for trading setups that supports buying the asset. And here we have the downtrend, the opposing side of the uptrend, or we can call it the reverse of the uptrend. So in a downtrend, the market is literally selling more than it's buying. You will see the price of the assets falling down aggressively, more than the rising up, and in this market, the sellers are more in control than the buyers. The downtrend starts by creating a lower low, a lower high, and another lower low. And when you see the market make this movement, it means that the sellers are very dominant during that period in the market. This means that you should place more attention to bearish setups than the bullish setups of your strategy to take full advantage of the trend. Now, knowing how the trend works might look basic, but as we progress in this video, you will see how important that it will be in the strategy and in any other strategy that you will ever look out to trade in the market. And with that understood, let's move into how our strategy works and the various rules that surrounds it. Make sure you follow the rules to the last one. Now, as I said earlier in this video, the false breakouts usually occurs when traders are trading it against the trend. So some traders can see a breakout pattern forming in an uptrending market, and they begin to expect a breakout to the downside, when they are supposed to place their focus on looking out for a bullish breakout, since the buyers are dominant in that market. Now, in order to make things easy for you as a trader watching this video, you must begin to trade with the trend. And the best way to do that is that when you are in a bullish market, you only expect to trade a bullish breakout setup, and when you are in a downtrend, you must focus on only trading a bearish breakout setup. This will first help you to avoid a bulky amount of future losses. Now, how do we find a great breakout setup on the chart? Here is how to identify an incoming breakout setup on the chart. Here we have a bullish breakout setup. A great breakout setup must have 3 or more rejections from the weaker forces of the trend. So in an uptrending market, we want to see the market facing rejections from the sellers as they are trying to stop the buyers from moving to the upside. The psychology around it is that by the time that the buyers step in with full force, they will be able to overtake the sellers once more and move the market with a very strong volatility to the upside, thereby causing a bullish breakout. It's the reverse for the bearish breakout setup. There must be 3 or more rejections from the buyers who are trying to push the market up against the trend and move it in their own direction. But since the sellers are more dominant in a downtrend, that won't be possible, as the sellers will finally break the rejection area, causing a breakout, and then move the market down with a very strong volatility. Now, when this happens, it does not mean that we are going to enter the market. Immediately we see the buyers or the sellers breaking out of the market. We cannot enter immediately when the market has broken out. We need a very strong signal in the market that will identify to us the right time to enter a breakout. And for this, I found a very secret signal that works really great for breakout trading. This is the first time you are going to ever see this signal on YouTube. No trader has ever taught about it in the whole internet space. What you are about to learn will change your life forever. It will increase your profits in a very massive way if you take your time to learn and practice it endlessly. This signal formation is very simple, and it forms like this: a target candlestick, an opposing candlestick, and another target candlestick. That means that if you are looking out for a bullish breakout, it will form as a bullish candle, a bearish candle, and then another bullish candle. When this signal entry forms, you can take a trade after the last bullish candle. And for this to work, you must make sure that the signal entry is forming immediately after the breakout, at the breakout zone. If it forms before the breakout, we are not going to take it. You must only trade the entry that happened after the breakout. And then you place your stop loss a few pips below the first bullish candle, and your take profit target according to the overall size of the breakout setup. And from there you are good to go. You can do all the opposite for a bearish breakout setup. Now, let's see some few examples of this strategy at work on the chart. So here you can see that the market is making higher highs and higher lows, which shows us that the market is moving in an uptrend. And from there, we can see the market getting rejected at this level multiple times by the sellers, which gives us a good zone to draw our line. And notice how I only draw a line at the top of the setup, instead of drawing a box, like other traders do. If you have been following, you will know that is because we are no longer looking for a two-side breakout pattern, like other traders do. But instead, you're looking for a determined breakout to the upside, because you are in an uptrend, and you are a trend follower. So, after that, we had a strong breakout, and as you can see, our entry candle formation has formed, giving us a go-ahead to enter the market and trade it. So we place our stop loss a few pips below the first bullish candle, and our take profit target, according to the size of the overall breakout setup. And as you can see here, our take profit target was hit successfully and our trade was a successful one. Now, let's see a bearish formation of this. So here, it is clear that the market is moving in a downtrend, as we can see lower lows and lower highs movement. And right here, you can see that the market was trying to go down, but it is facing multiple rejections from the buyers, who are trying to take the market up. And as you can see here, it has faced more than 2 rejections at the same zone. So we draw out our line on that zone to mark a breakout zone, and here the market finally broke out. But as it broke out, it formed our entry signal formation. You can see a bearish candle, a bullish candle, and another bearish candle. When you see this, it means that the market is ready to be traded. So we can finally take our trade, placing our stop loss a few pips above the first bearish candle, and our take profit target, according to the size of the overall breakout setup. And right here, you can see that our take profit target got hit successfully, giving us a wonderful trade, although I can go on to give you a lot of examples on this strategy, and many successful trades that this strategy has given us. But knowing how good a strategy works is not enough. You must also practice it by yourself to come into an experiential knowledge of it, so that it will finally stick with you and never leave your brain. So take your time to backtest them and use them to trade to see how great it works. In this video I taught you a trading strategy that made me so much money in the market. In this one, I will be teaching you how to start technical analysis from scratch, from a beginner analysis to a pro trader, in less than 22 minutes. You will be learning the structures, candlesticks, and every single tool that we use for technical analysis. See you there, my tribe soldiers.